Hello and namaskar everyone. Welcome to our commodities audiocast where we explore the dynamic world of commodities trading. In this audiocast, we will delve into the latest trends, market insights, and key developments shaping the commodities landscape. I'm your host and guide Ravindra Rao from Kotak Securities Commodities Research Desk. Once again, volatility was at its peak with dollar index trading traded as high as 103.57 in the initial part of the previous week, and precious metal witnessed some sell-off. The rally was supported by fresh data that showed US economy remains strong, strengthening the case for Fed to continue to raise rates. The ISM Services PMI unexpectedly jumped to 53.9 in June, and private businesses added 497K workers to their payrolls. This was again in June, the most since February 2022, whereas continuing claims fell to the lowest in 4 months. However, in the later part of the week, dollar index fell, ending the week in red by 0.64%. The fall came on Friday after the latest labor data cast some doubts over the need for further tightening by the Fed. The US economy added only 209,000 jobs in June, the least since December 2020, but the jobless rate decreased slightly to 3.6%, and wage growth of 4.4% surpassed market expectations. Traders now fully price in a 25 basis point hike in a Fed funds rate this month, but the odds for another quarter point increase beyond July has decreased. Focus will now shift to US and China inflation print in the week as it may drop cues on the state of price pressures in the policy divergent economies. On the price front, we have been continually telling in our podcast that the dollar index might face resistance near 103.50 to 103.60 zone, which is the falling trendline resistance. This has happened again as the high last week was 103.57. We stick to the resistance near 103.60, and now the support is pegged near 101.90, which is the second reaction low of the rising trend line. If that is taken out on a daily closing, the fall might once again extend till 101. US CPI data might be the trigger for this week. Now coming to commodity specific, COMEX gold ended flat, recovering from the earlier losses on Friday as a weaker than expected US jobs report triggered short covering. Earlier in the week, gold slipped to $1908.4 troy ounce, near 4 month lows, as US 2-year Treasury yields, which are most sensitive to Fed's rate expectation, jumped to 16-year highs of 5.12%. Silver prices rose past $23 per ounce, extending its rebound from the 3 month low of $22.2 touched on June 22nd, and outperforming gold prices as low supply and strong industrial demand outweighed pressures from the Fed's hawkish outlook. US inflation print might set the tone for the week. On the technical front, COMEX gold has been trading in a stiff range. On the lower side, 1902 is a good support, and on the higher side, 1938 to 1940 has been acting as a good resistance because it was the earlier support which broke and prices went down till 1902. So now that has become the resistance. So until it is below 1940, we expect the range of 1940 to 1902 to continue. A break of 1940 on a closing basis might support the bulls, and they might initially take it to 1950, 53, 54, which is the immediate resistance, followed by 1979. So until that is taken out, we are still maintaining a consolidative view, and on the lower side, 1902 is the support. If that breaches, prices might go lower. So till then, the consolidative range would continue. In case of silver, the silver is looking a bit bullish. We have been telling that silver looks to outperform gold since it formed a Morningstar pattern on the lower side. And along with the Morningstar pattern, there is a harmonic pattern 5-0, which is a bullish pattern. And if that kicks off, we might see prices once again going towards $26. Now this is in the short to medium term. And for this, the lower point would be the Morningstar low, which is close to 22.14. Now this should act as the support, and below that the pattern might negate. So till then, we expect bullish momentum to continue in case of silver. There is one trend line resistance near 23.50. If that is taken out on a closing basis, then the prices might shoot up towards the 60-day moving average resistance of 24.19. So silver looks bullish. In case of MCX as well, there is a Morningstar formation at the lower end, which is 67,515 is the support. So below that it might negate. Otherwise, we expect prices to move higher. In silver also there is a in MCX silver also there is an falling trendline resistance near 71.600. If that is taken out, it might move higher towards 72,700. Coming to energies, crude oil prices continue to rally and jump to two-week high of 72.40 barrel as supply cut announcement by major exporters Russia and Saudi Arabia were able to offset demand risk from higher interest rates. Also, comments by Saudi Energy Minister that Russia Saudi Oil Corporation is still going strong as part of the OPEC Plus alliance, which will do whatever necessary to support the market, supported an upside. Oil output in OPEC member Kazakhstan also slumped due to power outages, forcing the country to import gasoline from Russia. Elsewhere, EIA data showed that US crude and gasoline inventories declined more than expected last week amid higher demand. On the price front, crude has once again come close to the resistance of $74, and if it sustains above 74, then there is a chance it might move higher towards 77.50, which is the 200-day moving average. There is a mild resistance near $75, which also needs to be taken out. So we would take 75 as a good resistance, and above that the prices might go higher till 77.50. In case of MCX crude, the resistance is pegged near 6110, and if that is taken out, we might see prices going higher towards 6340, 6350 odd levels. So watch out for the resistance near 6100. A sustained close might turn it further bullish. In case of natural gas, the prices have come down last week. Although there was a breakout of a triple top, prices have slightly retreated. But we need to see how it moves going ahead, because the prices have come close to the falling trendline support, and we expect this throwback might end here, and the prices might once again move higher. Today, in the early morning session, it is around 2% higher. So let's see how it moves going ahead. But the technical pattern still shows a bullish momentum, and we might anytime see prices going higher towards $3. Finally, coming to base metals, LME base metals extended declines on renewed concerns regarding China's property debt crisis and a rising prospect of higher interest rates for longer. Already disappointing economic data from the US and China are hurting demand prospects, with latest manufacturing PMI figures highlighting deteriorating factory activity in June. Focus will now shift to China inflation print and Chinese trade data. Technically, copper and zinc still looks quite positive. Zinc, we have been telling that there is a bullish engulf formation on the weekly chart, and the prices might move higher. The price have been subdued. It has been trading in a very small range since past few days. But watch out for the resistance of 216. If that is taken out on a closing basis, we might see prices going higher towards 222 again. So we maintain a bullish stance until 204.80, which is the pattern low of bullish engulfing. Until that holds, we expect prices to move higher. In case of copper also, there is a formation of a morning star, which has been confirmed, and the low of the pattern is near 702.50. So until that holds, prices look to stay higher. Immediate resistance is near 726, and then 729. If it sustains above that, prices might go much higher. So immediate target would be 726, 729. Immediate support would be 713, and strong support would be 702.50 from the short term perspective. In the week, the central stage will be taken by the US inflation print for June, followed by speeches from several Fed officials. US inflation print will be the major data ahead of the FOMC meeting on 26 July. Any signs of elevated core CPI might continue to bolster the expectation of further rate hikes and lead to higher treasury yields. This might be slightly negative for commodities and vice versa. Other data prints include the Michigan consumer confidence and producer prices. As we wrap up our commodities audiocast, we hope you gained valuable insights into the fascinating world of commodities trading. Stay informed, keep an eye on global developments, and utilize the tools and knowledge available to make informed trading decisions. Thank you for tuning in. Any suggestions, questions, or ideas for future episodes are welcomed. Feel free to reach out to us through your advisor, or connect through our social media handles. All the best. Trade safe.